All right, we should be live now. I do apologize. I was having some technical difficulties, still figuring out this live stream, but welcome back to the Almost Friday YouTube show. My name is Brian Dean. I'm a former investment banker with a Master of Science in Finance, and my goal is to help you master the market. We do this stream every Friday from about 12:30 to 1 o'clock. This week we got started a little bit late, but I appreciate you for hanging in there. And we're going to give an update on a few things. The reason why we do this stream from 12:30 to 1 o'clock is because I run an indicator called Bollinger Bands, and this is the indicator that I use to determine whether or not it's time to buy the dip. And this indicator requires that we review it every week before market close on Friday. In case you weren't aware, markets close at 1 p.m. Pacific. And so every Friday we come in here and check to see whether or not it is time to buy the dip. So to do that, I'm going to go into here, and I've got SPY pulled up. This is the S&P 500 ETF, and I've already got this study pulled up, but for those that are interested in the behind the scenes, this is where we select our Bollinger Bands. We're going to make this 52 in terms of length because we want to see the 1 year moving average, and we're going to look at this on a weekly chart, and there are 52 weeks in a year, so hence the length is 52. And for standard deviations up and down, I like to look at 3 standard deviations up and down for the upper and lower bands. And this just sets a range for where what this range shows is 99% of the time, this is where the stock market has been over the last year. So if I close this out and save those settings, you'll see that I've got 3 lines here now. This middle one is the trailing average. However, this is a monthly chart. Because we want to see this on a weekly basis, I'm going to switch this to a 5-year chart and have the frequency set to 1 week. So here we are at 1 week, and this is going to be a more accurate representation of Bollinger Bands for this type of chart. And you can see that we've got a red line, a yellow line, and a green line. And what we're looking for is whether or not the price is below the green line. So for this week, we can see that that price has not gone below that green line. So it is not yet time to buy into this dip. Now, with that being said, I want to answer the question of whether or not this means I am quote unquote short the market or holding cash at the moment. For my portfolio, I am holding a mix of 60% stocks and 40% bonds. And the reason I do that, even though I'm on the younger side, I have a long investment horizon, I think that we're currently in a period of extended volatility, and I think that that's going to last for quite some time. And so a 60-40 split in your portfolio between stocks and bonds is still going to allow you to participate in upside in the stock market if we continue to go up from here. However, if we continue to extend lower, that portfolio setup will do 2 things for my portfolio. One, it will shield me from some of this excess volatility because bonds have performed a lot better in volatile times than stocks have. If I look up bond ETF ticker BND, you can see that year to date, we're actually up 1% on this ETF versus if I look at something like SPY year to date, you can see that we are down 3%. So when you combine the 2 in a portfolio, you get much less volatile, more predictable returns. And in my view, what are we trying to do here when we invest? We're trying to grow our net worth. We're trying to outpace inflation. And I would like to do so on a predictable basis, not on a hyper volatile basis. The second thing that a 60-40 split in my portfolio allows me to do is that as we extend lower into this market decline, and I'll get to in a second why I think we could go even lower from here, it gives me room to reallocate more money into stocks if I choose to do so. So if I have a 60-40 portfolio and we do cross below this Bollinger Band, or if we get to a place where I feel like stocks are undervalued, then I can go from a 60-40 portfolio to a 70-30, or I can go from a 70-30 to an 80-20, or I could even go into 100% stocks, or I could take on additional leverage either through margin loan, or I could dabble in options or levered ETFs as well if I want to take on that extra risk. So let me talk about why I think the market can potentially go down from these levels. Number one is that markets are currently very volatile based on the current administration's stance on tariffs. And I think that the market is in this reactionary, quote unquote, buy every dip phase, which you can see here. We have 1 week where the market's down and another week where the market's up and another week the market's down and another week where the market's up. And we've gone up again. And later in the live stream, I'll explain why we're up this last week. However, I want to remind everyone watching this that this last peak in the market was the week of February 17th, 2025. it has been 2.5 months since then. We're only 2.5 months into this, what I'll call market cycle. And so what I want to do is I want to take this chart and show you the max history of the S&P 500. And let's see if I can pull up the actual index on here. This should be SPX. The reason I'm pulling up the index versus the ETF, by the way, for those that don't know, is that the SPY ETF has only been around since, I want to say, the late 1990s or the early 2000s. So it doesn't have history going all the way back to the early 1900s like the actual S&P 500 index does. Just a quick pro tip for everyone watching. So what I want to do is I want to take you back to previous market downturns. If you look at the most recent one here in 2020, late 2021 going into 2022, remember that this was a time when inflation was hitting 7, 8, 9% annualized year over year, and there were a lot of fears that we were going to fall into a recession at that time. You can see that from this market peak in December 2021, we didn't hit our market bottom until October of 2022. So that downturn there was the better part of a year. And again, we are just 2 months into this market cycle. So I'm not convinced necessarily that we're going to go up from here. Let's take a look at a few other recessions. This one was the Great Financial Crisis in 2007. And the duration of this recession was from October 2007 to March 2009. So it was a full year and a half before we finished going lower. And we did have these periods where we had, this is on a monthly frequency, so we had 2 full months of the market going down and then 3 months of the market going up. And if you imagine yourself as an investor at this point in time, you might think, oh, you know, that was a little scary, but the market always goes up no matter what. Well, guess what? In the following year and a half, the market went down about 45%, I believe, from top to bottom. And if we take a look at the recession before that, which was more of a tech crash, this is called the dot-com bubble. Here we saw a top in March of 2000, and we didn't see the bottom of this market until around July of 2002. So what is that? Another year and a half from top to bottom. So the reason I'm pointing that out is because I personally think it is a bit premature to say one way or the other whether this market is going to go up from here. I think that a lot of signs in the economic data that I look at, a lot of the signs, a lot of my experience as well as an investor since around, I would say 2011, 2012, so over a decade here, is that we're just at the beginning of this market. If I were to put a bet on this, if you wanted me to put my paycheck behind what I think the market is going to do, I hesitate to say that we're going to go straight down. What I think we're going to see is a lot of volatility. You've seen this huge move downward in a very short period of time compared to what we've seen before. This is almost as big as what we saw here in 2020 during the COVID recession, in early 2020. And we've seen a similar move here just from these first few months of tariffs. And there's no sign that that's going to end anytime soon. So what I think we're going to see is a lot of this volatility continue. We're probably going to see equities stagnate at this level. They may go down a little bit. They may go up a little bit, but they're going to be very volatile. And so for that reason, I am staying in a 60-40 split portfolio between 60% stocks and 40% bonds. I am very hopeful that at some point we have some catalyst that pushes us below this lower band, this 3 standard deviations below our historical average. And this is where I would start to lever up in a big way in equities. And let me show you just a few examples in case you haven't seen my analysis on this indicator before. Here's an example of in June of 2022, when we had the really big inflation scare. We had extended periods of 7%, 8%, 9% inflation. You can see that we had this extended volatility that drove markets lower. And at some point, we did fall below that lower Bollinger Band, and this would have been the time to buy. And of course, from this period all the way up to today, we had I want to say a 50%, from 4,000 up to 6,000, a 50% total increase in stocks. So that is what I'm waiting for. So let's talk a little bit about some of the recent news we've seen over the last week in terms of why stocks are headed higher. Number one is we got a report today that the job economy is still strong, or at least for now. What's so interesting is that when you see these headlines come across on the latest economic data releases, is that at least in my view, when I read these articles, I see a news apparatus that is trying as hard as it can to spin these data releases in a positive light. So let's read through this a little bit. Employers added 177,000 jobs in April despite tariff uncertainty, and hiring slowed slightly from March's pace while the unemployment rate held at 4.2%. So if you were to look up this this employment report, you would find, let's see if we can find it, May employment report. You'll find a lot of headlines that talk about how this was a strong jobs report, and it's resilient ahead of tariff turbulence. But the reality is that we're not even into this full tariff situation yet. There are still quote-unquote negotiations going on. Tariffs have remained steady. And I want to show you an example of how tariffs have impacted me specifically. I was in the market for a DJI Pocket 3 camera. Now, before I pull up the search report, these cameras used to be in the $500 to $600 range, and sometimes you could get them even cheaper in the $400 to $500 range. Now, these cameras all start at $800, and this happened overnight because of tariffs. And these changes just happened this week. So this is one example of how I think we still have a long ways to go where to see these tariffs work their way into the consumer economy, and you're going to see less consumer spending. You're going to see lower profits from businesses, which could ultimately throw us into a recession. And the next piece of data I want to show you as we get closer to our stop time here at 1 o'clock is GDP, gross domestic product. For those that don't know, this is a measure of the total amount of, I kind of want to call it income. Let's call it income. The total amount of income that a company's citizens generate. And what you'll see here is that we typically grow quarter over quarter around 3%. But more recently, the first quarter report came in at negative, I want to say 0.3, yes, negative 0.3% compared to 2.4% the quarter before. Now, what does this mean? Why was GDP negative? It was primarily for one main reason, and let's see if we can find the actual, let's see if we can find the table that breaks this out. I think it was here. Now, let's see if we can find it. So there's a table I'm looking for that breaks out the components of GDP. And what you'll find is that a lot of companies were pulling investment forward in advance of when tariffs were going to take effect. I think it was in the Wall Street Journal. Let's look at this one. Not quite. See if we can find it in the source data. Here we go. Okay. So this table right here breaks out the components of GDP. And what you'll notice here is very interesting. First, we had a huge deficit in imports. And what this means is that companies had a huge shift in pulling forward demand. They were essentially buying lots of equipment for their businesses by importing those goods from overseas before tariffs went into effect. And keep in mind, this is all first quarter data. So this is January through March. At the same time, companies increase the amount of investment, and these two effectively cancel each other out. And what I really want to draw your attention to here is consumer spending. Consumer spending here is the piece that I don't think has gotten enough attention here, and you can see that it's quite low. It's under 2%. And this is an early indicator of what could throw us into a recession. And remember, recessions are typically led by consumers. When consumers stop spending, businesses stop making money. And when businesses make less money, they start laying off their workforce or reducing pay. When people get laid off and their pay is reduced, they have less money to buy goods. And this cycle repeats itself until we get to a new break-even point and we're able to come out of that recession. So that is a little bit of a deep dive into GDP. And it'll be very interesting to see where we are next quarter because, again, this is, number one, this is an advanced estimate. So this number will get revised in the coming weeks. And then secondly, this data is all from before tariffs were fully into effect. This is January through March. And we're not going to see Q2 data, which would be April through June, until sometime in July. So we're going to have to wait another 3 months or so before we see the true impact of this tariff situation. And so that's about everything that I wanted to cover today. We're getting close to our stop time of 1 o'clock, but I wanted to open it up for questions. I see a few folks in the live stream. So if you have any questions related to the market, related to investing, portfolio, personal finance, feel free to ask them. If not, I have one last thing that I would like to show you before we head off for the weekend. All right, so last thing I want to show you is I've been making a few improvements to my website, which is completely free for you as a viewer, and that is briandean.com. On this website, I've included a bit more information about myself, but I've also got a blog that I've started publishing content on again. And I wanted to show you this article, which I think applies to quite a few investors out there. In fact, I got a question about this last week. And the question that I got was this, hey, Brian, I have about $1,000 in my investment account, and I would like to know how to invest it. And so I pointed that person to this article, which is my step-by-step guide to how I would invest $10,000 right now. But I want to tell you that this will apply to you whether you have $1,000, $10,000, or even up to $100,000. Everything in this article would apply to you. And again, this information is completely free. And I do plan on posting to my blog more often going forward because I find that this information is very helpful, especially as a reference point for some of these common questions related to investing and personal finance. So I'll just skim through this real quick. Step one is to understand your investment horizon. This is the most important part. Is your investment plan 1 to 5 years? Is it more like 5 to 15 years? Or is it 15 years or longer? This will essentially dictate what your portfolio looks like, whether you have $1,000, $10,000, or $100,000. For example, if you have a short-term investment plan, you probably should not be investing in more volatile assets. If you are going to pay for home improvement in the next 5 years, or you're going to pay for some college tuition, you don't want to see your portfolio value drop 20% if it's in stocks right before it comes time to pay that bill. So in this type of investment plan, you'd want to focus more on bonds and CDs, versus in a longer term investment plan, then it would be more appropriate to invest a lot more in stocks, in say an 80-20, where 80% of your portfolio is in stocks and 20% is in bonds, or just 100% into stocks. So that's a little bit of a plug for my website. That's briandean.com. If you aren't signed up to the newsletter, I highly recommend that you do. It's completely free. Over 95% of my subscribers are still subscribed. And I highly encourage you to sign up and see for yourself. So with that said, we'll close it out here soon and get ready to move on with our weekend, another weekend of not having to check our portfolio and see what the stock market is doing. But I'll leave it open for any last minute questions. Otherwise, we can get going. All right, going once, going twice, close. Thank you everyone for joining me for another fun live stream, the Almost Friday YouTube stream. Again, this is a free investing seminar with me, Brian Dean, a former investment banker with a Master of Science in Finance, and my goal is to help you master the market. And I will see you next week.